Well, hello everyone, and welcome to our webinar with Fannie Mae, improving margins and price competitiveness with the Fannie Mae Mission Score API. As we normally do with our webinars, we are going to give it about 2 minutes till 11:03 Pacific, and for another 100 people or so to trickle in here, and then we will get started at 11:03 Pacific. All right, we're going to go ahead and get started. As always, for those of you that trickle in later, we will be sending around the recording to all registered attendees. Like I said, we're real excited to have this webinar with Fannie Mae. Real excited to talk about the Mission Score API, and I think there's a lot of questions from our clients, from I think just in general in the industry, how about the Mission Score, the different components of the Mission Score, and so we're really excited today. Actually, I'll go into the panelists right now. We're really excited today to have Olga Gorodetsky, who's the director of the investor side of capital markets, the buy side of capital markets, for Fannie Mae. And we obviously represent the sell side, and so this is really nice to have Olga on a webinar with us. This is, I believe, the first time. And I think for most of you on the call, because most of you are probably MCT customers or have heard myself or Paul talk before, my name is Phil Rasori, COO of MCT. And of course, we have Paul Yarbrough, who runs our client success group at MCT. And so Olga is going to go through, and again, I'm not just saying this because Olga's on the call. We really are excited to, show, basically walk through all the mechanics and the parameters in the Mission Score API, because there are some some key differences. One of the things that we ran into when we were integrating with this API, we were working with Fannie Mae as kind of the guinea pig, was kind of working through with our programmers, talking about borrower address. And I myself had interpreted that as property address, but in fact, a feature which Olga will talk about here, a parameter, is actually where the borrower resides, not and if that's different from the property address, that matters. That borrower address still matters. And to my, as far as in the pricing world, obviously we don't deal with underwriting, but in the pricing world, to my knowledge, that's really the first time that's ever affected pricing, right? We have a lot of changes, between with the LMI or the FTHB AMI caps. That was the first time AMI affected pricing, right? Where you truly had to geocode a property address location to actually get an LLPA calculation, right? To see if that waiver actually applied. So big changes, and we're always excited to work with Fannie, as Fannie really truly revolutionizes pricing and gets more granular, because that's where we know the world needs to go. And I'll talk about the benefits after Olga goes through the program, the benefits that we see for originators, as far as transparency and that continuing kind of what we all of us in capital markets think of as the holy grail, to bring all of these back end executions through transparency and efficiency to the front end. So we're really excited to have the webinar. Yeah, we'll Olga will go through the mission objectives, how the mission score is calculated. We'll talk about the integration between MCT Marketplace and Fannie, and the benefits. And then Paul's going to speak to, in addition to speaking to the integration, Paul's going to speak a little bit to how we at MCT can help our lenders push this transparent front end price pickup that exists with these spec prices to the front end. Because again, like I said, that's what we're all here to do, right? And again, thanks to starting with Fannie, but both the agencies were able to provide that transparency. So with that, we'll jump into Olga's presentation here. And Olga, if you want to talk about the mission score and just the framework, that'd be great.
Thanks so much for having me, Phil. Very much looking forward to speaking with you. So I did want to start my remarks just by providing a high-level overview of the Mission Index Initiative and how it fits with Fannie Mae's priorities. So as you all know, Fannie's always looking for creative ways to carry out our mission of facilitating equitable and affordable access for borrowers and renters. But what's really unique about this initiative is that it actually was developed as a solution for the needs of another key GSE stakeholder, and that's investors in our MBS securities. So as the impact investing movement was gaining steam a few years ago, these investors came to us because they understood the role that the GSEs play in providing liquidity to underserved borrowers. And they also knew that our securities represented a large investable opportunity for that impact strategy. However, they did want more insight into the specific borrower attributes that were underlying the collateral. And so at Fannie Mae, we saw this as a great opportunity to expand the pool of global capital, that was investing in agency MBS. But we realized that we had to be thoughtful about how we were going to go about providing these insights that the investors were looking for. So we designed the Mission Index framework with the understanding that we needed to balance a variety of priorities, right? Not just investor demands, but also the borrower privacy considerations, as well as, of course, above all, the liquidity of the TBA market itself. And so the result was a disclosure solution that provides pool-level aggregated insight into MBS collateral. And so investors can now use these disclosures to identify pools that are rich in mission-oriented lending activities. And as I'll discuss in a bit, we've actually taken these disclosures one step further and used them to create a new specified story. And that story is allowing investors to pay up for pools that are not only mission-rich, but they also exhibit attractive prepayment characteristics. And so what we're hoping is that, just like well-known, well-established spec stories like loan balance, the pay-ups that the investors are paying for mission pools can spur a virtuous cycle, right, by improving the economics of lending to these borrowers. And so hopefully that'll help break down some of the barriers to access to credit that these borrowers face. So on the next slide, I wanted to start by providing a quick overview of the methodology, and that way, hopefully you can better understand how the pieces of the framework fit together. And so as I mentioned earlier, the disclosure that investors use to make investment decisions is a pool level aggregated disclosure, but it's based on loan level mission scores. And so every loan that we're acquiring is tested according to the 10 loan criteria that you see on the left-hand side of the slide. And these 10 criteria are then rolled up to the 3 dimensions. As you can see, it's income, borrower, and property. So we've color-coded them according to the criteria that they align with. And so every loan receives a mission score of 0 to 3, depending on the number of dimensions that it satisfies. And so this is where MCT's integration with our mission score API becomes so valuable. So each of these criteria highlights a population of borrowers, that we're asked to prioritize either by a regulator or by statute. And so understandably, there are a lot of moving parts in terms of determining which criteria a given loan satisfies. As Phil pointed out earlier, it's not as straightforward as just, subject property address. And I'd certainly be happy to get into the nitty-gritty of each of these individual criteria. I'll focus on, or I'd like to focus on that maybe a little bit later. But really, I just wanted to highlight the fact that tools like the API can simplify the scoring process and provide lenders with that loan level insight. And so how do we go from these loan level mission scores to pool level disclosures? So looking at the middle of the slide, we're just showing that these loan level mission scores are aggregated into 2 pool level disclosures. So the first one at the top is the mission criteria share, or MCS, and then we have the mission density score, or MDS. And so the MCS is the share of loans in the pool that meet any of these 10 criteria, and the MDS is the simple average of the loan level mission scores. So effectively, it's like a measure of the layering of mission-oriented lending activities for the loans in the pool. And note at the bottom that we are only scoring pools with at least 10 loans, and that's of course for borrower privacy considerations. Now, one of the most exciting developments, as I mentioned, from this initiative has been the launch of our social bond program earlier this year. And that's a key element that many impact investors are looking for. And so as we show on the panel in the right-hand side of the slide, MBS pools that have a 100% mission criteria share and a mission density score of at least 2 automatically receive a social label, and they're identified as social in our disclosures and on Bloomberg with that cute little blue heart that you see on the right-hand side of the slide. And so again, I will just reiterate what Phil said, which is that everything here that I've discussed is aligned between the 2 GSEs, and that's of course by design. And so this framework and the social bond framework also apply to Freddie Mac's securities. So moving to the next slide. Now that we've covered the framework and the parameters of the social bond program, I did want to spend a minute talking about the growth of this market, since we first started issuing eligible pools in March. So on the left-hand chart, the cumulative issuance volume of Fannie Mae social MBS has actually exceeded $5 billion through June. And that volume mainly comes from our whole loan conduit, but as you can see with that pink line, we've also seen 20 distinct sellers forming their own pools that qualify for the label. And so I should note that this chart includes all the pools that qualify for the label based on the criteria that I walked through on the previous slide. But the way that we're thinking about this in terms of the incremental volume of specified pools that this framework enables is what we've been referring to as high MDS pools. And so these are pools that are comprised of loans that would have gone into a generic, non-spec security, and they wouldn't have qualified for an existing spec story, so they likely wouldn't have gotten any payout. However, what we've seen and what we've highlighted to investors and to the market is that these loans actually have a more attractive prepayment profile than the other loans in generic pools. And that's likely due to the barriers that these borrowers face in terms of access to credit, right? That's what we're trying to address. So as we know, that more stable prepayment profile is something that MBS investors seek out, right? And they've been willing to pay up for that. And so we leverage this well-known market dynamic by creating the new high MDS specified story that would give investors the ability not only to direct their capital to pools that are rich, in loans that align with our mission, but they can also invest in an asset with attractive cash flows. So like any new product, as you all know, there's a learning curve that's involved with the high MDS story. And so investors as they get comfort kind of with the value proposition, right, and how it fits into their portfolios, we would expect to see, an appreciation and greater sponsorship. And it's been very gratifying to see the market adoption in real time since we came to market in March. And one way to think about this is with the table on the right-hand side here. And that shows the pay-ups that we've been receiving at our monthly auctions for the high MDS story as a percent of the payups that we've been receiving on the 250K loan balance story, which, as you know, that's a much more established story in the market. So you can basically see that at the start, in March when we first started auctioning it, the story, the pay-up percentage was about 33% of the 250K story, and now it's over 60% in some coupons, and that appreciation has occurred in the span of 5 months, right? And so there's still, obviously a range of views out there about the fundamental value of the high MDS story. And I do think it'll take additional performance history, right? We haven't had a rally, we haven't had a refi wave. But that's what the market would hopefully need in order to refine their view of the value. But it's obviously very encouraging to see it appreciate as much as it has relative to this established 250K story. And so perhaps the point to make here is that for loans, that are eligible for more established stories like loan balance, the best X is still going to be in those stories and not in the high MDS pools. But the demand for the high MDS story is growing, and it's definitely rivaling some of the lower pay-up stories like high LTV and even Geo in some coupons. And so that's where we see some new pooling opportunities. And since investors are consistently paying up for the story and that demand has appeared to be actually pretty robust and stable, we are planning to keep issuing through the conduit, of course, being mindful of the impact, of the TBA market more broadly. But we do think that there is sufficient scope to create enough volume in the story to satisfy investors without disrupting the TBA market. And so in order to keep creating these pools, we need to obviously keep acquiring mission loans. So flipping to the next slide, to do that, as you all hopefully know, and maybe that's why you're here today, Fannie Mae introduced the Mission Score 2 and 3 products in the whole loan conduit in May. And so that's where lenders can effectively take out commitments for these mission-rich loans and receive pricing based on the market payups that our conduit is receiving for high MDS bonds that we auction. And so we see these new conduit products as a transmission mechanism, right, of this signal that investors are trying to send by paying up for social MBS. And so taking advantage of these products is hopefully going to improve your execution for this subset of loans. And so we want to make sure, of course, that lenders are able to capture these payups, because improving the economics of lending to these groups can hopefully encourage lenders to seek them out more proactively and, of course, break down some of those barriers that we talked about. And so on the right-hand side, you can see that we've rolled out a number of resources that lenders can use to score their pipelines, take out commitments, create pools. And so we wanted to give lenders as much transparency as we could, and that's why we're excited to have MCT integrate with our Mission Score API. So with that said, I'll hand it over to Paul to discuss the new integration, and I'm happy to answer any more questions about the methodology or our products at the end. Thank you.
Well, Olga, that was great. Thank you, for all that information. I think that one thing, and just if Olga went through her pay-up matrix as a percent of the 250K low bow pay-up, and all of us at MCT talk to a lot of capital markets individuals in the industry, some old school capital markets individuals who talk about, hey, there's nothing, there was some skepticism, to this product that, there might not be any pickup outside of just the normal prepayment story that exists. And I think Olga's matrix there was really cool because and the first time we've seen anything like that, when she talks about, and thanks Paul, when she talks about going how that's gone up as a percentage of the pay up, one thing that sticks out to me just looking at that, if you look at the 6.5, if it was just based on the prepay story, the 6.5 obviously having those higher pay ups, right? The 6 being the market coupon, you would see that kind of float to parity faster than the 6. And if you see the 6 actually it looks like it's moving faster than the 6.5. And so there, we would read from that no, there is in fact a story here. And I think to one of the comments Olga made on prepayments, remember that the speeds, these are all anything that you guys see. Again, this is probably only for MCT customers on the line, but anything that you see that Paul's his rapid commit is throwing into an MS2 program or an MS3 program, mission score 2 or 3 program. Those have already been best X'd, and Paul's going to go into this in detail, but they've already been best X'd against the other available low bow executions. But I think that grid is great. We've never seen anything like that, and it makes a lot of sense that everything literally just 4 months ago is a third of the pay up, and now it's literally doubled. So that's great. So just as far as some of the benefits that we want to talk about, I think for most of you on the line that are MCT clients, and you probably hear us as a broken record about this. We were so happy with frankly, Fannie leading the market 8 years ago, bringing the initial specs into the cash window, the low bow specs. That really changed the ability, or allowed lenders outside of the very the household name lenders. It allowed the small to mid-sized lender to pass on these pay-ups, right, that exist in the securitization market. It allowed them to pass these pay-ups on to the front end, and our lenders, all lenders, did this in the form of these of specific programs, right? And so you all of a sudden you had the 85K low programs, and then you had the 150K programs, and as of course as the conforming loan limit raises, we all expect that you're going to continue to see higher and higher low bow, things that amounts that we wouldn't have considered low bow just a few years ago have pay ups. But again, so for those clients on the line, this is really a broken record. But at the end of the day, the mission score pay up is just another way to initially improve margins. But and Paul will talk about this later, in conjunction with using a product such as like our base rate generator, where you can actually put this pay up through in a responsible manner to the front end. You can start to get to where Fannie definitely wants you to get to, and both agencies want you to get to, as far as passing this to the front end. And so just specific to that last bullet point there, Taylor spec margin pass through using the base rate generator. So one of the risks that all lenders face when they start to pass through specified pay up execution to the front end, you start to take that spec risk, which as soon as you get that specified pay up, you diverge from that beautiful hedge that we have with the to be announced mortgage-backed security, right? It doesn't have a TBA; it trades at auction, and so we have a system where you can pass through a percentage of that based on execution, based on we're working to put it through based on term as well, lock term. And one of the things I would say that this, judging by what Olga just said, this probably is one of the safer specs to put through. On a previous webinar, you guys may remember that we talked about the concern that we have, the big concern we have of passing through some of these spec pay-ups that exist in the lower in the coupon stack, because that's really against the financial laws of physics. You shouldn't have that. You shouldn't have a prepayment story pay-up on a execution that is under par, but that exists at both cash windows. And so we would say we'd be probably holding back a larger percentage of those, right? On this in particular, based on Olga's comments, it's kind of the other direction, where we see you're probably safe to put a higher percentage through, although they don't want to put words in Olga's mouth, that they're starting to see better executions on these as more go through. So look, again, this is just we see this as another great step in the transition to more efficient a more efficient, more transparent pass through of these pickups, these payups that used to exist just as securitization payups for very large lenders, but now pushing them through to the front end and using technology integrations like MCT and Fannie can allow you guys to push this to the front end. So we're really excited about it. And with that, I think Paul, we can, if you want to move into kind of maybe talking about how we handle this on the normalization side, maybe the rapid commit side, that'd be great.
Yeah, thanks, Phil. Olga, great job as well. Yeah, so what we're doing here at MCT is we're taking the API, this mission score API, determining the score, and then ultimately pushing that back into a hedge pipeline or a product that you can then best X and commit. So this graphic on the left kind of shows the process flow here. So we obviously get the LOS data, which is going to have all our attributes in it, say like borrower income, first-time home buyer, subject property address, all the attributes we need to call that mission score API to determine the score. MCT Live picks that data up from the LOS or whatever the source of the pipeline is, and normalizes it, meaning we tell it, okay, here's what this state is, here's how to interpret this income, here's how to interpret this property address, and so on and so forth. We take that data and we send it through the mission score API. It's very quick, so we're able to send through a high number of loans every night. So every time data changes, so a big thing in the underwriting process, and I know we went through this last year with potential DTI hits, and now we have AMI percentages, so we have income is influencing that price now. So income changes a lot throughout the underwriting process, meaning it can affect your AMI. You could go from 79% to 82%, and it could affect the price on the loan. So we're taking that pipeline of loans for all of our clients, not just agency approved, and I'll talk about that in just a second, why we would do that for all clients. But we're taking that for all of our clients and pushing that through the API to get the score based on those criteria that Olga mentioned earlier. And so we take the score and then we determine, hey, if the score is a mission score 2, now we look at the rest of the attributes of the loan, non-owner, estate, a FICO score, and then obviously the loan amount. So all of those factors that can influence which spec score this loan qualifies for. The reason we take all of those is we want to know what's the best price. Is the LLB 85 the best price? Is the non-owner the best price? Is New York the best price? Which spec score is the best one? And then we take that data and normalize into a loan program that's going to signify which one was the best price. Now, as the clients know here, you do have the ability to override the automated normalization there. But for the most part, most people take a look at this and they have the ability to view the breakdown of the pricing just to verify that. But what we're seeing is that most of those loans above 275 are obviously best Xing into the mission score 2 or 3 product, as Olga showed earlier and Phil just spoke to as well. That's going to be better than your standard TBA or Con 30 pricing. Now, it might not be better than the 275, 250 and on down, and so you would still see an LLB designation in your program code there. So that's, we take that mission score API data, the returns from the API, we look at every loan and its attributes to make sure we are normalizing the program correctly based on the price. And then ultimately, the loan goes through the hedge and you're ready to get funds, hopefully, and then we can then put this out to bid in the marketplace. So in the MCT marketplace, remember, we are kind of a full best X where you can look at your MBS pricing, your aggregator bulk pricing, your best effort rate sheets, as well as your agency pricing, including Fannie, S&P, or a retained option. And so when we push this out through the marketplace, when a user initiates a bid request on their loans, the aggregators are also seeing that these have been normalized to a mission score product. So where that really helps Fannie from our point of view is that the aggregators have an axe to pick up those mission score loans as well, even though the borrower or the lender may not be approved with the agencies. And so really helping you know, every potential seller of this social bond kind of pick these up as needed. Now, let's what we've got on the top right here, this Fannie Rapid Commit screen. This is our Rapid Commit screen. You can see we designate loans into buckets of you know, Mission Score 2, Mission Score 3. That's the Fannie Mae product. You would also see your LLBs. If you're selling S&P, it would be broken out that way as well. And then you have your note rate range, your volume. You select your delivery date and you commit right here in MCT Live to those Mission Score products. Over here on the lower right, just an example of the kind of pay-ups we're seeing. This is from earlier this week. So you can see up in those higher note rates, it really does start to pay off. You know, it's 7.25 note rate, almost a point on a Mission Score 3 program. So, you know, as Phil mentioned, there is some, with the initial spec just rolling out, there is some kind of back-end execution improvement that we all of a sudden get to participate in. And with this some certainty moving forward, we'll get to hopefully push these into the front end as well. So it's not always just a windfall for the lender, but actually influencing borrower rates and execution. And then we move into our base rate generator tool. I'm going to spend 2 seconds on this slide. This tool is really just what you're seeing here is our setup and where you run this from. You're basically able to generate a rate sheet that you would load into your PPE, or a formatted rate sheet that you distribute to your brokers or your retail LOs. Maybe you have a real estate agent you want to hand deliver a rate sheet to, or like I said, just a flat file that you need to push into your PPE. So our tools here allow you to kind of pull in any kind of source pricing, be it an MBS price, if you want to consider some excess servicing in there, or be it the cash window or a best ever rate sheet. Any source of pricing you have, we can pull those in and generate your rate sheet based off those. And we have several margining tools, including float calculations and just flat margins overall, rate margins, delivery margins, buffers, all that kind of stuff. So we can definitely give you a bigger breakdown. I won't go too much into it right now, but there are some videos on our website, mctrading.net, that you could check out and really goes deep dive into it. But I think what's important here to talk about, and this is just us setting up the rate sheet and showing you can, you know, upload these into any PPE out there. But what I want to show specific to the spec and the spec stories that are out there for from the agencies is when you select your product that you want to best sex to, maybe you have it against a couple different servicing options, maybe an S&P and a retained option. Sometimes you don't want to always go to the best because maybe it's too far, so you can modify the best. And in relationship with, and by what I mean by modify the best, maybe you want to go to the second best, or you want to take an average of the top two. All of those options are set in here to generate that rate sheet. But then what's really important is what Phil was alluding to earlier is when you go in and you want to select that, you want to start delivering the mission score products or any kind of LLB spec story product into your front end rate sheet. So specific to the mission score, what we can do is we set up a mission score 2 program, and then we can call it whatever we like. And this is where we're really proud of our ability to develop a margin holdback. So in this case, what I'm suggesting here is I've got a mission score 2 program, and then I would compare that pricing, the spec pricing, so that would be the mission score 2 pricing, to the base price. So what's the base price? Con 30 in most instances, right? So I have just a regular conventional 30-year, comparing that price, and then you'll have the spec pay up that will generate, and we're just calculating the difference between the two prices. And then you can put in a holdback. So you can't see it here. I covered it up with this other window, but this basically says hold back. And what I'm suggesting here is I would like to hold back 20% of that spec pay up, meaning I'm going to pass through 80%, but I'm going to hold back 20%. So, you know, like Phil said, maybe in the higher coupons, you want to hold back a different amount than the lower coupons. So you can kind of set it up how you want to in here. So you can create a rate sheet that's pushing out these spec stories like the Mission Score products, and push it out with an extra bit of margin in there to protect yourself with any fade in the payout. So, you know, with that, that ran through those pretty quick, but we'll end with any questions that people have, or Phil or Olga, if y'all have any follow-up comments to that.
No, that was great, Paul. We actually did have one question with a guy with a really cool name, Phil. He had asked whether or not you know, we'd be giving the aggregators you know, the proper the info needed so that the aggregators could price to these. And you had, I believe you covered this, but I just wanted to make sure we covered that question in detail, because that is obviously on the aggregator side, they're very interested in what MCTs can be providing through you know, MCT marketplace.
Yeah, no, it's a great question. And so what we're doing today is driving the Mission Score program name. So meaning if it does qualify for the Mission Score a 2 or a 3, and the pricing is higher on those for that particular loan, then you're going to see the Con 30 MS2 or Con 30 MS3 as a program name. Further down the road here, within the next few weeks, we'll probably be actually delivering that Mission Score as a separate attribute into the bid tapes as well. Meaning you could have a Con 30 LOB 85 that has a 3. Today you wouldn't be able to see that because it's not, the LOB 85 is going to be better priced, so you have a program that says Con 30 LOB 85. And then as an attribute, we'll add in Mission Score 3. So I think what's important there, right, is that if you have, maybe if the aggregator is picking up some sort of optimization on their pool and suggesting they could give up on the LB 85 to make their mission density score or mission share score better on a pool, then that could be important for them to pick that up. So today they'll see the 2 or 3s as long as they best execute that program. And shortly, very shortly, we'll be pushing that score into the bid tape as an attribute itself.
And that's a really great detail there, Paul. And for the sellers on the line, just to understand, you know, what Paul's saying there is, if it is that, you know, $84,000 loan, our kind of mindset is we term for purposes of pricing. Obviously, we're gonna label those to the best execution. But at the end of the day, the aggregator has the ability, you know, let's say it's an $84,000 loan that can go into a 110, a 125, that, you know, they know from the loan amount already with that information. Obviously, we're not taking the loan amount away when we put the program in. But it's a really good point, right, that Paul brings up on, you know, if it is that low val, and you know, there definitely is value in potentially, especially on like a 3, because what we've noticed, and Olga probably has much better data on, definitely has much better data on this. I won't ask you to get it, Olga, but what we've noticed is that the 3s, there's far less 3s than 2s. And so I could see, to Paul's point, even if it is an 85K, that's, you know, 2 points in execution through the 3, the aggregator might want to be collecting those 3s to stick in to get to the scale of a security that actually allows them to securitize the MS3. So, No, that's great. The really good overview from both you guys. Olga, do you have anything else you wanted to add?
No, I think that was more intended to be a high level understanding of the initiative, how it fits into our priorities. But to the extent that folks really have more detailed questions around the contributing criteria, they can certainly reach out to us. And you all have done a great job of reaching out when there are issues or questions. So we need everyone's support, obviously, in order to make this successful and to really be able to transmit that signal. And so, this is unique because it is a market-based incentive, right? It's not Fannie, determining pricing. It's not FHFA setting LLPAs. And so, we hope that to prove this out as a proof of concept that the market-based incentives really are helpful to helping remove the barriers to access for these populations. So thank you all for your help.
No, that's great. Thank you, Olga. I think again, going back to that matrix, it's very clear that there's good progression here, and so it would be our recommendation for all of our customers to continue to watch this. If you're a base rate generator customer, start to break this out in your rate sheet. As you can see from Paul's grid here on the bottom right, there definitely are pickups for those that hit. They're definitely sizable. So with that, Paul, I think since we only had one question there. Whoa, let's see. It looks like did one come up right here? Oh, that was good. Maybe that was Ian asking that question. Will the presentation be available for replay? Absolutely. So everyone, as I had said at the beginning, for those of you that came in late, everyone will be getting everyone registered will be getting a copy of this recording, and and again, if you're you can reach out to us or your Fannie representative as well if you have any questions on the program. But with that, I want to thank Olga and Paul. This was a great presentation, very informative, and really appreciate your time.
Thank you so much.
Yeah, thanks, guys.